a couple of things would be, again, coming back to management. If we don't like the management, we're just not going to invest. And what does that, we often get asked, like, how do we judge management? It really comes down to how they deploy capital. So if we come across management teams who are hell-bent on a pure M&A growth strategy, we generally make our way to the exits pretty quickly and the meeting's over fairly quickly. We tend to favour companies, on the other hand, that they invest in their own R&D, and that's how they generate organic sales. So management's really important. And then probably another one would be, but again, if we don't find it, we're not going to apply like a discount PE. We're just not going to invest in the company. I think another one would be just the sustainability of the franchise, because not all franchises are that sustainable. And if you take, like, an example in the last couple of years would be like Under Armour, so in the athletic space. So we're shareholders in Nike. We've followed Lululemon over the years, but if you look at someone like Under Armour, it was a really popular stock a couple of years ago. People are asking us, why don't you own it? Why don't you own it? And like, what pushed us back from that, amongst other things, was that they started getting a bit big for their boots. I think they thought, we're going to take on Nike. We're going to move out of our lane, which was, and basically get into athletic footwear, and ignore the fact that even Adidas couldn't really compete with Nike, but Under Armour thought they could, and it ended in tears. And it was always kind of ended in tears because they were taking on the 400-pound gorilla. It was just going to be too hard, but they barged on anyway. So I think it's that sustainability of franchise. Like, so you need, like, as investors, you need to make a judgment call really about whether their long-term plan makes sense or not. There's a company in the US called Yeti. So really interesting consumer brand company, founded by two brothers in Texas. Their initial customer base was actually almost like the hunting fishing community. So and they started the business by building basically coolers, drinkware. It's been very quite heavily focused within North America, and but they've got this incredibly loyal customer base. I've referred to them as the Lululemon for men, in that they target these products towards, it's a real sort of the outdoorsman, if you like. And they started probably, their products really started to take hold in states like Texas and Colorado, Arizona, California, and then they're still growing within the US. But from an external perspective, there's only, there's around 5-6% of their sales, I think, are outside the US at the moment. But there's a lot of scope to growth, lot of scope to grow. So it was actually in Australia. I think their sales in Australia actually doubled last year. So COVID's been a huge benefit, and it's in particular what it's done is driven a lot of revenue to their online store. And with that, the margins are much higher, and they're actually moving into the luggage category, which hasn't been great for some, but they've got this incredibly loyal customer base, and so that should work really well. And then from a profitability and growth perspective, they've generated, even though they're young, like, they're still generating 15% return on capital. They've grown their revenue at about 18-20% per annum the last 5 years, and they should be able to maintain that. So I think that's a really interesting company. But again, they've stuck to their knitting, and kind of a bit sort of unlike Under Armour, they've stuck to their strength. And so I think looking at what Lululemon have done over the last 5 years is a really good insight as to what Yeti can possibly do over the next 5 years.